You can almost feel it in the air, can't you? That buzz around the next Federal Reserve decision.
Oh, definitely. Lots of investors are basically holding their breath right now.
Yeah, wondering what it means for, well, everything, Bitcoin, stocks, gold.
Exactly. And that's what our deep dive is all about today. We want to pull back the curtain a bit on past Fed easing cycles.
See if we can spot some patterns, right? Find some useful insights for maybe the next 6, 12 months.
That's the plan. Look for those clues history might offer.
Okay, so specifically, we've got the September 18th, 2025 decision coming up. The market's pretty much expecting another quarter-point cut.
Yeah, 25 basis points seems to be the consensus. That would take rates from 4.5% down to 4.25%.
And that's a fifth cut since this whole easing thing started last September.
It is. And here's where it gets, really interesting. History tells us rate cuts often mean rallies.
But it's not that simple.
Not at all. The kind of easing cycle makes a huge difference to how assets actually perform. It's definitely not one size fits all.
Okay, so we need to look back. You mentioned playbooks.
Right. History gives us sort of three distinct scenarios.
Right.
Let's start with 1995, the preventative cut. What was that about?
How did that play out?
Well, what's really key there is that Greenspan, he made this gentle, proactive cut, just 75 basis points, taking rates from 6% down to 5.25%.
So not reacting to a disaster.
Exactly. The economy was strong,
Yeah.
maybe showing signs of overheating a little. So this was like a tap on the brakes, not slamming them. It engineered that perfect soft landing.
And the result?
A really steady bull market. The NASDAQ, for instance, went up like 5 times over the next 5 years. Pretty amazing.
Wow, okay. Golden age stuff. But then 2007, a very different picture. The rescue attempt.
Total contrast, yeah. During the subprime crisis, the Fed had to slash rates massively. We're talking 500 basis points.
5%.
Yep, from 5.25% basically down to 0.25% in only 15 months. But the thing is, it was too late.
So assets still tanked.
They plummeted initially and then really struggled. The economy was already heading into a major recession.
And then the most recent one, 2020, the panic response during COVID. That felt like chaos.
It really was. Emergency cuts again, 1.75% down to 0.25% in just like 10 days. Plus unlimited quantitative easing.
Right, the Fed's balance sheet just exploded.
It did, from $4 trillion to $9 trillion. Huge volatility followed.
Yeah.
Eventually, we got that kind of sharp V-shaped recovery.
And Bitcoin, that went wild.
Oh yeah, surged over 17 times, from around $3,800 to $69,000. Just incredible.
Okay, so quite the range there. Preventative success, a late rescue, and then outright panic buying. Where does that leave us now in 2025? Is it like any of those or something new?
Well, it's a bit of a mix, actually. You look at the indicators now. Unemployment's low at 4.1%. GDP is growing. Inflation's around 3%.
Sounds a bit like 95.
There are similarities, yeah.
Sure.
But there are also some pretty concerning differences. The S&P 500 is already at record highs, unlike 95 when it was recovering.
Right.
And maybe more importantly, U.S. government debt is way higher. Debt to GDP is 123%. Back in 2007, it was 64%. That limits options.
Less room to maneuver fiscally. So what's the projected path for rates now?
The expectation is for maybe another 100 to 150 basis points of cuts over the next year, year and a half, settling rates somewhere around 3.0% to 3.5%. So kind of a middle path. More than 2019, but much less extreme than 2020.
Okay, that makes sense. Let's bring Bitcoin back in. How did it handle those earlier, less dramatic easing cycles? Like 2019, those first cuts didn't do much for it.
No, they didn't. Bitcoin actually went down after those 75 basis points cuts in 2019.
Why was that?
Well, liquidity was still pretty limited in crypto then. Investor confidence was shaky after the 2018 bear market. And big institutions mostly weren't involved yet. The money flowed more into stocks.
But 2020, completely different. That 312 crash, then the massive surge. Is it fair to expect anything like that 17x again, or has the game changed?
I think the game has fundamentally changed. Yes, the 312 crash, Bitcoin dropping from $8K to $3,800 was brutal, driven by a global liquidity squeeze and too much leverage. But the rebound was fueled by, $5 trillion in liquidity from the Fed and big names like MicroStrategy and Tesla jumping in.
Institutional adoption.
Exactly. Now, in 2025, Bitcoin's sitting around $115,000. We have ETFs. Institutions are deeply involved. It feels much more like rational prosperity.
So stable growth, not moonshots.
More likely, yes. Stable growth rather than those exponential gains of 2020. The
Yes.
market's just more mature now.
Okay, quickly touching on traditional assets. Stocks usually like rate cuts, but you said the reason matters.
It's crucial. And what's really interesting now is that stocks have already done really well since the cut started last year. S&P 500 is up 16%. NASDAQ up 30%.
That's well above average, isn't it?
It is,
Yeah.
especially the NASDAQ strength. That tells you something about the current risk appetite.
And bonds, the stable but unexciting option.
Well, they're reliable. Falling rates mean rising bond prices. The 10-year Treasury yield is already down 94 basis points.
Room for more.
Potentially another 35 to 75 basis points. If yields drop another 0.5%, a 10-year Treasury holder might see maybe a 5% capital gain. Modest, but their main role is anchoring the cost of capital.
Got it. And finally, gold, the stable winner in easing cycles.
It's been remarkably consistent. Historically, gold averages about a 32% return over 2 years during easing.
Yeah.
But this cycle, it's already up 41% in just 1 year.
Wow. Beating its own history. Why?
Several things driving it. Big central bank buying this whole de-dollarization trend you hear about. Geopolitical risk is definitely a factor. And of course, its classic role as an inflation hedge.
So even though Bitcoin might have higher percentage gains?
Gold's market is enormous. It absorbs a huge amount of capital, even with smaller percentage moves.
Okay, so here we are, September 2025. Feels like an interesting point in time, maybe moderate greed, but also some caution mixed in.
I think that sums it up well. And based on these historical patterns we've discussed, the next 6 to 12 months, that could really be a key window for some significant moves.
But as always, the future's unpredictable, isn't it? We could see anything from AI boosting productivity massively to, I don't know, more geopolitical tensions or even another financial wobble somewhere.
Absolutely. And maybe the deeper point is that the fundamentals are shifting. The whole dollar-based system, how we think about storing value, how quickly wealth moves, it's all changing.
A profound shift. So the final question for you, the listener, has to be, are you ready for this changing landscape?